Silver just crossed $100. The old rules are dead. For decades, silver was trapped under a psychological ceiling. 2 digits felt normal. Anything higher felt temporary. But now it's trading in triple digits. Spot prints as high as $115.59, and futures in China pushing over $110. That's not a test, that's a break. And once a market escapes resistance like this, it doesn't move in meat lines anymore. It moves in gaps, surges, and sudden repricing. Here's the contradiction that hits you personally. The higher the price goes, the harder it becomes to get in. Because this has stopped being a value trade. It's turning into a momentum trade. And if you're waiting for $90 again, you may never see it. But here's the part nobody is saying out loud. The real risk isn't the spike. It's what happens when you try to exit. What you're watching isn't just a breakout. Silver crossing 100 didn't happen in slow motion. The pace is compressing, and that changes how you should read every move from here. Historically, the market took 145 days to climb from 20 to 30. That's a grind. That's people debating, hesitating, waiting for confirmation. But the move from 90 to 100 took only 10 days. That's not debate. That's urgency entering the system. Now watch how fast this escalates. When price starts jumping in $10 blocks, like they're single steps, the usual investor rhythm collapses. Weekly analysis becomes too slow. Monthly dip buying becomes fantasy. And the market starts behaving like it's headed somewhere it's not supposed to go. So here's the real framing question. If silver can gain $10 in a week, what happens when the next move isn't 10? Because the predictions are no longer about someday. They're about timing. Targets like $150 are being discussed in weeks. $200 is being floated in months. And once the crowd believes time has sped up, behavior changes first. Price follows. The biggest danger right now isn't price, it's liquidity. Because the physical market is splitting into 2 different worlds, and most people don't realize it until it's too late. In one world, pure .999 fine bullion stays liquid. Bars, rounds, clean standardized metal. In the other world, legacy silver is starting to freeze. Refiners are effectively stepping back from alloyed product. 90% constitutional, junk silver, and sterling. Some are refusing it entirely. Others are accepting it with delayed payment windows that stretch from 10 days to 3 months. Notice what that means. Your metal can rise on paper while your ability to convert it into cash collapses in real life. Dealers need fast turnover. They buy, sell, repeat. But if their capital gets trapped for months waiting on a refiner payout, they stop bidding aggressively. They stop taking product. And suddenly the market you thought was always liquid becomes a slow-motion lockup. This is where the story flips. Because at triple-digit prices, more people will try to sell, and the weaker forms of silver will become the first ones to choke. So if liquidity matters to you, the behavior shift is clear. Stop thinking only about what you own. Start thinking about what you can actually exit. Now the signal isn't coming from traders. It's coming from the sovereigns. Because one of the clearest forward indicators in this entire story is how official institutions are pricing silver right now. The United States Mint has repriced proof silver eagles to over $170 per ounce, roughly double the spot price at the time of the decision. That's not a casual markup. That's a statement. It's the issuer effectively telling you, we don't believe this move is temporary, and we refuse to sell into a market we think is going higher. Here's why that detail changes everything. When a sovereign issuer sets a triple-digit premium, it helps establish a new floor in the public mind. It normalizes the idea that $100 silver isn't high. It's simply the base layer of the next regime. And it quietly pushes retail psychology into acceptance mode. If the official price is $170, then $110 at a local shop suddenly feels like a bargain. But notice what's happening underneath that perception shift. The mint can charge a premium because it has captive demand. Subscribers, collectors, people who buy no matter what. That pricing power becomes a pressure wave that eventually spreads into the rest of the market. So the real question isn't whether $100 holds. It's whether the new floor is being built above it, by the very institutions that can afford to be early. This is where the retail frenzy becomes fuel. Because silver isn't behaving like a normal commodity anymore. It's starting to behave like a Veblen good, where higher prices attract more buyers, not fewer. A whole new class of participants is pouring in, not because they understand the market, but because the chart is screaming and the dollar feels weaker every month. The demand isn't educated, it's reactive. Dealers are describing a reality that sounds impossible in a calm market. They're buying 6 figures worth of inventory daily, and the showcases still look empty. Not because supply vanished overnight, but because retail offtake is immediate. The metal doesn't sit. It gets stripped the moment it arrives. Now watch how fast this escalates. This kind of mania creates scarcity in the places you actually buy. Local shops, online listings, small dealers. Not necessarily in the global spot price you see on a screen. And once those shelves stay empty long enough, buyers stop thinking and start grabbing. But here's the part nobody wants to admit. Frenzy is expensive. It raises premiums, it reduces choice, and it turns rational accumulation into emotional chasing. So the strategic behavior shift is simple. Don't compete with the crowd at the top of the candle. Secure access during the lulls, build relationships before you need them, and treat availability as its own price. The institutions didn't just lose control, they stepped aside. Because one of the most profound changes in this rally is what's happening on the short side. Reports describe a market where there are 10 million shares available for borrowing to short silver, and almost nobody is touching it. In normal cycles, that kind of borrow inventory invites pressure. It invites smart money resistance. But right now, attempting to short is being described as pure insanity. Notice what that implies. The old ceiling wasn't just psychological, it was structural. It was built on the assumption that big players would always be willing to lean on rallies. But in this phase, the trade has capitulated. The predators are no longer hunting the upside, they're avoiding it. This changes the texture of volatility. In past years, silver could drop $5 in minutes, not because the market was broken, but because the suppression machinery was active. Now the incentives look flipped. Banks that accumulated physical metal are no longer threatened by higher prices. They benefit from them. This is where the story flips again. If the institutional sell wall is gone, the market doesn't need permission to climb. It only needs a lack of sellers. And that's how you get vertical moves that don't look rational until they're already finished. So if you're waiting for the classic smashdown to get your entry, you may be waiting for a world that no longer exists. And now the story hits your life. Because when silver moves like this, it doesn't stay confined to charts or investor forums. It bleeds into ordinary decisions. What you can afford, what you can protect, and what you can't replace once it's gone. In a fast market, the price isn't just climbing, it's compressing your time. The window to act shrinks. People who move slowly pay more. This is where the friction becomes real. You might see a spot number on a screen, but in the physical world, you're dealing with premiums, shortages, and availability that disappears between breakfast and lunch. You're dealing with the difference between what something is worth and what you can actually buy it for today. And if you're holding the wrong form of silver, the pressure doubles. Because you can be up in theory, while your exit path gets clogged by delays, refusals, and slow payouts. That turns a winning trade into a trapped position, even as the headlines keep cheering. If this feels familiar, Say so in the comments, because this isn't just about silver. It's about what happens when the financial system moves faster than real-world liquidity can handle. But here's the part nobody is saying out loud. When markets move this fast, the next shock doesn't need to be economic. It just needs to be sudden. Silver is no longer a metal story. It's a system story. Because the mechanism driving this isn't just supply and demand. It's incentive, leverage, and global pressure points snapping into place at the same time. Momentum pulls in new buyers. Rising prices turn hesitation into panic. And physical constraints turn panic into scarcity. The system amplifies itself. Look at the hidden lever, liquidity, not price. When refiners slow down or refuse certain products, the market doesn't just get expensive, it gets uneven. 0.999 fine stays fluid. Secondary silver starts to clog. Dealers tighten bids because their cash flow can't sit frozen for months. And the spread between what you own and what you can sell quietly widens. Here's why that detail changes everything. In this regime, the real power belongs to whoever controls throughput, who can source, refine, and deliver metal without delay. That's why sovereign pricing signals matter. That's why retail mania matters. And that's why institutional capitulation matters. They're all symptoms of the same machine, a market that's transitioning from normal trading to inventory warfare. This is also why you're seeing strategic behavior changes. Less waiting, more securing. Less theory, more execution. Because once the system starts rewarding speed, the slow participants become the exit liquidity. Now, watch how fast this escalates. Once you understand the mechanism, you realize the next leg isn't driven by belief. It's driven by structure. The next move is being shaped thousands of miles away because the center of gravity for silver pricing is shifting east, and that changes everything about how the West experiences dips. The Shanghai Futures Exchange is trading silver at a premium, roughly $10 above Western spot. That spread doesn't just sit there. It pulls physical metal across the planet. Inventory flows toward the higher bid, and Western vaults feel the pressure. Notice what that means for you. The price you see on a screen isn't the full story. It can be a lagging indicator. If Asia is consistently paying more, any weakness in the US price becomes an invitation for arbitrage. Buy here, ship there. Capture the spread. And that behavior creates a hidden floor under every pullback. This is where the story flips into global logic. It's not just American investors bidding silver higher. It's the world re-rating real assets through different lenses. Different currencies, different trust levels, different political incentives. And once a commodity becomes part of that cross-border tug-of-war, cheap doesn't last long. So the practical shift in behavior is simple. Don't anchor to one reference price. Watch the premium, watch the spread. Because if the Shanghai pricing stays elevated, Western markets don't get to choose where silver settles. They get dragged there. And if that spread widens instead of shrinking, the next acceleration may already be forming. Now comes the decision that separates gamblers from strategists. Because silver isn't just rising, it's outperforming. And the proof is in the gold-silver ratio. With gold near $5,000 and silver above $100, the ratio has compressed below 50 to 1. That's a regime change. Historically, once this ratio starts dropping, it can keep falling toward 40 to 1, 30 to 1, even 15 to 1 in extreme cycles. But here's the part nobody says clearly. Outperformance is a gift, and gifts expire. Silver is the high volatility engine. It can deliver explosive gains and then punish hesitation with violent swings. Gold is the stability anchor. It doesn't move like silver, but it preserves what silver created. That's why sophisticated investors don't pick a side. So the near-future trajectory splits into two paths. Path 1 is pure momentum. Silver runs hotter, the ratio keeps compressing, and the rally feeds on itself. Path 2 is strategic preservation. As the ratio drops below key thresholds, you begin a staggered rotation, exchanging a portion of silver's volatility into gold's density. Neither path is guaranteed, but both paths are rational, and the next move is already forming inside your risk tolerance, because the higher silver climbs, the more painful it becomes to protect gains too late. Here's the final twist. The highest upside may not be in the metal. It may be in the companies chasing it. The mining sector is already showing the signals of a capital stampede. Bought deal financings are happening without warrant sweeteners, meaning demand is so strong that companies don't need to bribe investors with extra upside. That's what institutional appetite looks like when it stops negotiating. And at the same time, a valuation disconnect still exists. Producers are re-rating, but junior explorers, especially those with high-grade potential, can remain mispriced until the market fully wakes up. This is where the opportunity becomes generational, not because it's easy, but because the exit path is clear: M&A. Majors that fail to find new reserves during the bear cycle eventually have to buy what they didn't build. And when a junior proves scale, the market stops valuing it like a lottery ticket and starts valuing it like a target. But notice what's missing in most investor behavior. People chase story stocks. They buy names with hype. They ignore structure. The smarter filter is teams and geology, district-scale potential, stacked structures, modern exploration skill, not lifestyle companies. So here's the loop you should hold on to. The silver breakout is the headline, but the second-order effects, liquidity strain, global price gravity, institutional realignment, and mining acquisition pressure may be the real trade. And the next question is the one that decides everything. When this cycle matures, will you still be able to exit cleanly? That's what we're breaking down next. So subscribe if you want the next layer of the system. Silver didn't just cross $100. It exposed the real game. The surface story is simple. Triple-digit silver, price discovery, momentum. But the deeper story is about what breaks first when a market accelerates: habits, liquidity, and the infrastructure people assume will always work. When refiners refuse certain forms of metal, when payment windows stretch from days into months, and when the spread between spot price and sellability widens, you learn a brutal lesson. Being right on price is not the same as being free to act. This entire cycle can still split into different futures. A melt-up where silver sprints toward $150 and beyond. A structural grind where it holds above $100 and builds a new floor. Or the worst-case twist, a world where the price is high, but the exits are narrow, especially for the wrong kind of inventory. So don't just ask, how high can silver go? Ask the smarter question, what can I actually sell when everyone tries to sell? Because in the next phase, the winners won't just be the ones who bought early. They'll be the ones who planned the exit before the crowd realized the door was shrinking.